My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends trying to make you some money. My job is not just to entertain you, but to educate and teach you, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. Sometimes there's just too much good news to ignore. And that's how I'd explain today's rally. Dow gaining 183 points, S&P advancing 0.92%, Nasdaq jumping 1.41%, all coming from much lower levels. Now, one of the most infuriating aspects of this market, at least for the last couple of weeks, is that nothing seemed to matter except for bonds. If bond yields go higher, money managers, well, they just hit the machines and they sell. They know you can't fight a market where rates have exploded higher. That's what they think, right? And that's when the Wall Street playbook says you just got to sell everything. Don't even distinguish. But let's go back to the machines. These days, the playbook has been turned into what I call an algorithm, so that when you get certain inputs, like rapidly rising long-term rates, lots of funds automatically sell stocks no matter what. Do you know that there might not even be a human involved in the decision? The bigger the fund, the less likely there is a human at the helm. I mean, that's how defined they are. And what they typically sell is the S&P 500, the entire bundle of 500 stocks, usually through what's called a commodity future. So no major stocks get left out because it's the asset class they want to bet against. The portfolio managers who trade like this don't pick and choose what they sell. They don't say, let's sell the S&P futures, except for those 40 stocks I think are actually pretty good. They just sell everything. They don't even want to distinguish. Why? Because they don't get paid enough to try to distinguish between the good and the bad, and in many ways, individual stocks are just too small to matter. They regard stocks as commodities. They're like corn or soy, right? It's just a bunch of soybeans in a basket, 500 of them. They have no desire to pick that basket apart. That's too much work. They don't want the hassle of picking stocks, and they're trying to make a bet, not against the individual companies, but about the class that are equities. Think about it. How often do you hear big money managers come on TV and actually name the companies they dislike? Oh, no. For the most part, aside from some notable exceptions like the ones who go on Scott Wapner's halftime show, you just hear those vague generalities about how stocks in general are overvalued. That's what we're speaking about. Stocks in general are overvalued as S&P 500 costs too much. Sure, there are times when these top-down portfolio managers get a little more granular. They'll talk about sectors they don't like, the techs, the oils, the healthcares. But for the most part, the real famous ones, they run so much money, they can't make meaningful bets on individual stocks. Their positions would be too big. And that's why they only talk about the averages. Trying to pick stocks for them is like commodity investors betting on a particular stalk of wheat. Now, on down days, like we had last week or yesterday before the term, the stocks as commodities analogy really does work. When the market's getting hammered, pretty much everything trades together, and it feels like a waste of time to distinguish among the grains of stock. Oh, look at that grain of stock that is General Mills. That did well. Oh, the grain of stock that is Clorox. Ooh, that was up. Oh. But then you got to say to yourself, what happens when bond yields actually go down, as they did today, and the stock market finally catches its breath? What happens when Jay Powell comes to Capitol Hill for his confirmation hearing and doesn't go on the anti-inflation warpath? Nothing about how we need lockstep rate hikes to break inflation and might need 4 of them or more. Instead, he says it'll be data dependent like the old days. Because maybe once we get over COVID, there could be a cool down in inflation. And that's what happened today. And it made us want to see what is worth buy. We see the trees through the forest, so to speak. And it turns out that while the forest was looking pretty terrible, there are enough healthy trees that it makes sense to do some buying. So let me give you some concrete examples of what's been going on in the basket as we just traded it as a unit. First this morning, Morgan Stanley raised its price target for a company we all know called Amazon from $4,000 to $4,200. It's based on something I felt pretty thin, the number of engineers it has. Apparently, there's so many engineers working at Amazon, it must have some other bets that could be worth fortunes. As it is, Morgan Stanley says Amazon gained a lot of North American retail market share and had a solid holiday season. Given that many individual retailers didn't have such good Christmas numbers because of Omicron, and yet the consumer's flush, it makes a ton of sense that Amazon must have had a terrific quarter. So now the stock is zooming, and I've got to tell you something. It is about time. This company at 3,307, up 2.4%, is still 400 points below its high. Second, Apple. All right. Now, we've had multiple research notes in the past few days that indicate Apple had a really good holiday season, not to mention excellent Chinese sales. But that kind of data hasn't mattered. Apple stock was getting dumped along with everything else. It's a part of the S&P. And remember, to many money managers, it's just a few kernels in a bushel of corn. All right, not one kernel, a lot of kernels, but it's still just a kernel. It finally mattered today, though, and the stock had a nice bounce. It did, I'd say, I don't want to say it was against what the S&P did because the S&P went up. But let's just say when the S&P was still doing nothing, it started to go higher. It was a kernel of recognition. Third, right now, J.P. Morgan's having a gigantic healthcare conference. For the most part, these companies are having tremendous quarters. Over and over, we've heard companies saying terrific things. It hasn't mattered, though, because even though the healthcares got dragged down by indiscriminate selling, well, this is a huge sector. And for nearly all the stocks to have good things to say and raise numbers should not be overlooked. But it was overlooked. That's kind of nuts. But again, they're part of a bushel. We like Zoetis, the pet and livestock care company, on later in the show, but that wouldn't matter in a whole big. You could have like a whole grain, giant box of grain. You wouldn't see Zoetis from Adam. Or how about the two talks that NVIDIA gave last week? Do you know they gave two? They told you how well gaming was doing. It's right on the web. And how data centers are going and how fast the selling's been. And indicators, they indicated this quarter might be better than expected. It was completely ignored. Then there's AMD's Lisa Su, who gave you a terrific roadmap at CES last week that shows that things could be excellent for the chip maker for multiple years. It was driving me crazy that no one even seemed to even listen. Again, to a lot of the hedge funds, though, these stocks are just pieces of corn, indistinguishable from any other. On a day like today, though, those guys aren't in control. 6, we all know Boeing's been in trouble, right? But today we learned that 737 MAX, the numbers for 2021, turns out they weren't that bad. Now, they're not a lot better than expected. But think about this. If travel comes back and the airlines need more capacity, they could see a big uptick in orders. So the stock goes up $6, but there could be much more to it, which is why we're holding for our travel trust. Again, no one cared when this stuff came out when the market was still down, and people yawned. Why? Because Boeing's part of the S&P. But when the interest rates calmed down, Boeing went to the fore. Of course, there will always be some companies that do disappoint. We've seen a bunch of retailers report weaker than expected numbers for December, the most important month of the year, by the way. But we're also hearing that January, usually not an important month, but it's been a barn burner for many companies. And the earnings estimates are being lifted for 2022, not cut, because inventories are so lean and there's no post-Christmas promotion. Now, if you're a huge portfolio manager who only thinks in terms of asset classes because anything more granular than that is too microscopic to matter, then maybe you don't care that Costco had a fabulous month, or GE's been upgraded by multiple firms, or CVS just pre-announced much better than expected numbers. To these big-time portfolio managers, people like me who try to distinguish among the individual companies are a waste of time and are wasting their time. They see us as small thinkers, Lilliputians even, looking for valuable quarts of oil in a 55-gallon drum. But to you and the millions, hundreds of millions of people who don't trade stocks like live cattle or soybean futures, it absolutely does matter. It should matter. It always will. The bottom line, when bonds finally go in the right direction and J. Powell stays thoughtful, we get ourselves a stock picker's market like we had today. You have to be ready for these because the stock market that dies by the bond market sword can also prosper from it. David in Florida. David.
Booyah, Jim.
Booyah, David.
So I'm a member of your investing club, and I read a lot how much you love Chevron, but I also want to ask you about Exxon.
Well, I don't blame you. And first, I'm glad you're in the club, David. We're getting ready to do some really exciting things, including some videos. Now, it is very difficult to distinguish Exxon from Chevron because they're considered to be both great companies. Now, Exxon is a lot more troubled company, and it's been going up, and Chevron's much less, and it's better growth, and it's been going up. We own Chevron because we like the balance sheet, we like the dividend, we like the buyback. Exxon's been troubled on the buyback. Well, let's just say Exxon's balance sheet has been stretched. And one look at the dividend, even up here after this amazing run from Chevron, Exxon is yielding 4.9 and Chevron is yielding 4.1, even though Chevron has had just gigantic move. Let's stick with Chevron. Justin in California. Justin.
Jim, greetings from sunny San Diego.
Oh, good to have you.
Here's the situation. I made an absolute bundle by getting in on Tesla early, and I'm thinking that right now might be a really good time to diversify. I'm a huge fan of the EV sector, and I'm wondering what would be your top 5 EV companies aside from Tesla?
Okay, well, I mean, what I've been saying, just so we're clear, is that EV is a very, very crowded field. I mean, crowded. There are so many battery companies. There's so many companies that make the stuff within a battery. There's so many companies that are just kind of just out there making metals like MP. So what I've simplified things and just say, look, own Tesla. They're the number one. And if you want what's on the come, then do what we did in Action Alerts and buy Ford, which has a very electrified group of fleet coming out next year, and it'll be more and more electrified. And I think that unlike most of the companies that have EV vehicles, theirs are going to sell well. All right, sometimes there's just too much good news to ignore, and that gives you a stock picker's market where we look through the bushel and find what's great to own. Mad Money tonight. Healthcare is taking over the farm. Fresh off the company's presentation at the J.P. Morgan Healthcare Conference, I'm getting the latest in healthcare for analysts with the CEO of Zoetis, which is one we've liked for a long time and is very inexpensive versus where it was not that long ago. Then after a couple tough weeks for the Nasdaq, could today's bounce be a sign of what's to come, or is it just a flash in the pan? I'm going off the charts to find out. And BioMarin popped today after releasing data on one of its phase 3 treatments. And I'm getting the latest on the results with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.